It is Thursday evening, and that, of course, means we're talking shares on tonight's edition of Your Money, Your Call. Great to have your company this evening. Plenty of callers to get through, so I'm going to go straight to John from Maramba. Hope I've said that right. John, welcome to the program.
Yeah, hi Nina, hi guys. Really enjoy the show. I've just got a question with regard to a mining services company I've been following for quite a while called Industria, ticker code IDL. I've recently substantially increased my investment in it due to the amount of contracts they seem to be winning, and took advantage of a capital raising they had at about 40 cents. But with the market now starting to get a bit jittery, I was just wondering whether that was a wise thing to do. Should I pull some money out and see if it goes lower, or if Roger or you guys think it's fairly sound, I'm happy to hold for medium to long term. And quickly, if there is time, I'm sitting on a rather large profit on Extract Resources, EXT. Is it time to take some off the table and keep some powder dry in case the market does fall a bit further?
Industria is a sound business. So in answer to the question, yes, and I think its share prices reflect. Oh, there you go. So the share prices reflected that, and it's had a terrific run, obviously, since March. It is now more expensive, like the bulk of companies that I look at. It is more expensive than its valuation, and so as a result, if he's nervous. If the caller's nervous, and I'm sorry, what was his name?
John.
John. Yeah. So if John's nervous and he's overextended himself, then sure, you need to consider the possibility that, one, you're feeling uncomfortable because your position's so large, the price is way above the value, and to me that sounds like he needs to actually sell some shares in order to get more comfortable.
We've got Brett from Brisbane up next. Hi, Brett.
Good evening. Just a question for Roger. Just wondering, given all the different share prices of different items, what would be one or two companies that would pay the best fully franked dividend?
I get this question a lot. It's a mistake to actually focus only on the dividends without thinking about how those dividends are derived. So it's all very well buying a company because its dividend yield is high. But if those dividends are funded by debt, for example, Telstra or Macquarie Infrastructure Group, if companies are revaluing assets and then transferring the revaluations to the undistributed surplus account, and then they're borrowing money to fund the payment of a dividend, well, that's just not sustainable. So you could have a really attractive yield, but have a business who really its quality isn't fantastic. Much better to buy a business that has a very high rate of return on equity that you can buy at a really high dividend yield. So focus on businesses that generate high rates of return on equity, then look for a high dividend yield. You'll generally do okay, and that's without, of course, calculating an intrinsic value.
Think about the Myer IPO.
We had a brief look at it. We also had a look at Kathmandu. I think it opened today, didn't it? It closed about $4.10.
Yeah, $4.10. It lists on Monday at $4.10.
Not the issue price, yep.
Which is at the bottom range, I think, of the indicator.
$3.90
the bottom
was the
point
low,
of the indicator range.
Yeah, I think it's going to open about 15 to 7 times earnings. So, I mean, I suppose it's fair value for a standout market-leading retailer. Just in terms of the other retailers, its competition, DJ's, JB Hi-Fi, they're trading about P's about 20. So if you look at it that way, you could say it's trading on a slight discount, but it's probably coming at the wrong time, laying for this pullback. In terms of Myer, it's a great business, and but it might just be I suppose it's fair value at the moment. Yeah,
do you reckon $4.10 fair value?
No, I think it's expensive. In fact, my valuation on Myer, and this has been published all around the world now, but my valuation on it is about $2.90.
Oh, that is significantly less.
Yeah, it is a lot less. But let me say this, in the short run, prices are based purely on popularity. 146,000 people applied for a prospectus for Myer, so that tells me it's popular, and so they got it away at $4.10.
You've got to hand it to them. It was a pretty good advertising campaign, wasn't it?
Well, yeah, and Kathmandu is exactly the same. I've been just flitting between Melbourne and Sydney probably too many times in the last few days, and I've noticed that on the sides of the car parks at both Melbourne and Sydney Airport, you've got these enormous Kathmandu posters advertising their sales or whatever it is that they're advertising. But these things are timed to coincide with the capital raising. I've never seen them there before. Myer is expensive. Its valuation is about $2.90. In 5 years' time, if they hit all their numbers that they say they're going to hit in the prospectus, it might be worth $3.90, and you're paying more than that today.
Yeah. Gentlemen, we'd like to take you to an email we've received from Dominic in Geelong, who has a question about Challenger Financial Services. This is stock code CFG. What are your views on the stock at current price levels, considering its current share purchase plan and the financial services companies coming out of the global financial crisis? That one coming from Dominic in Geelong. Josh, what do you reckon, Challenger?
I actually don't know much about it, but a lot of funds management. Actually, I'm not too sure about it, so...
Okay, well, we might move on to Roger for that one.
It's expensive.
Yep.
Really expensive.
You reckon everything's expensive, Roger?
Yeah, I'm sorry to disappoint you, but I've made a lot of money not buying things when they're expensive. Yep. And I know people are itching to buy something, but sometimes the best thing to do is nothing at all. And with Challenger, that's one of the businesses I would do nothing at all with.
All right. Gentlemen, before we go to our next caller, other big yarn out today, of course, ANZ. Sure. The full-year cash profit beating analysts' expectations. Banks has cashed up for potential acquisitions. We've got the whole move into Asia. We've got the new logo and all that kind of stuff. What do you think?
I think ANZ, NAB and Westpac are going to be the underperformers compared to the CBA over the next couple of years. Having said that, when John Simons came into the Australian market with Aussie home loans, the banks were making net interest margins of about 400 basis points or 4%. Now, thanks to the likes of John Simons and his peers, that was brought down to about almost 200 basis points or 2%. So the net interest margin for the banks was halved, yet in that time, their profits grew dramatically. Now, what's happened is the global financial crisis has come in. Like a tsunami, it's wiped out all of those non-bank lenders and competitors. So their market share has increased. Their margins are creeping back up. The net interest margin for the ANZ's gone back up to about 230 basis points. And I almost can guarantee that they'll continue to go higher, and they'll only go in one direction. You want to own banks on an island. You know, it's a terrific institution to own. Fancy owning a business where you charge people to get at their own money. Yeah. You know, it's just fantastic.
Don't talk to me about it.
Having said that...
I'll lose sleep over it.
Having said that, the CBA's economic performance is going to be a lot better over the next couple of years, almost double the other banks, simply because they were able to buy Bank West from a distressed seller. The other banks haven't been so lucky in terms of their acquisitions.
Darryl from Perth, thanks for waiting, Darryl.
Show. I've got a question for Roger, please, about Monadelphous, the code's MND. This company's in resource management, in servicing and engineering for mining and that sort of thing. They've got a market capital of 1.143 billion, and they've had high return on equity over the last 3 years, over 60% return on equity every year for the last 3 years, and their long-term debt is only 10% of their market capital. I just wondered what Roger thought of them.
The guys are going madly through their notes to see if they can find a Monadelphous. And this one, if I've got it right, Gary Stone from Share Wealth Systems, formerly ShareFinder, who's a regular technical analyst on the show. This is one of his favourites. If I've got this right, I hope so. But I think he's been pretty pleased because you can see how it's done since the start of the year.
It is. I know I'm going to find my sheets and valuations for this company after the show's over, but I do know that its value continues to rise dramatically over the next couple of years. It's trading at a slight discount to its current value. Not enough of a discount to be really aggressive in terms of buying, but at a slight discount, and the value of the company continues to rise over the next couple of years. So I agree with the caller that, it is a good company. It does generate very high rates of return on equity, modest debt, if any debt, and trading at a discount. So it's sort of it ticks all the boxes, if you like.
Gentlemen, we're going to take a short break. If you've got a question for my panel, 1300 30 34 35 is the number to dial. Don't go anywhere. Back with more of your calls in just a minute. Stay with us.